How do some of the richest people on Earth become billions of dollars wealthier, while in certain years paying little or even no federal income tax? Not by hiding money, not by moving it offshore, and not by breaking the law. They simply play a completely different game. A game built on 3 words: buy, borrow, die. Those 3 words may be the closest thing Wall Street has to a cheat code, not because they're secret, but because almost nobody explains how they work together. Most people spend their lives earning money. The ultra-wealthy spend their lives owning assets. And those 2 things are taxed very differently. Here's why. Imagine 2 people. Both are worth $50 million. The first person earns $50 million in salary. Every paycheck is taxable. Before much of that money ever reaches their bank account, the government takes its share. Now imagine the second person. They don't earn $50 million. They own $50 million worth of stock. A year passes. Their shares double in value. They're suddenly worth $100 million. On paper, they just became $50 million richer. But here's the part that surprises almost everyone. They haven't sold a single share, which means, under current US tax law, they generally haven't created a taxable capital gain. The wealth exists, the taxes don't, at least not yet. And that's where everything begins. Because the wealthiest people in America understand one principle better than almost anyone else. You don't pay capital gains tax simply because an asset becomes more valuable. You pay it when you sell. That single distinction has shaped modern billionaire wealth for decades. It explains why some of the richest people on Earth rarely rush to sell the assets that made them wealthy. Instead, they build entire financial strategies around never selling in the first place. That strategy has become known as buy, borrow, die. It's controversial. It's completely legal under current law when implemented correctly. And it's one of the most misunderstood concepts in finance. Over the next few minutes, we'll break down exactly how it works, why banks are eager to lend hundreds of millions of dollars to people who never sell their stock, how billionaires fund lifestyles most people could never imagine, without liquidating the assets that made them rich, and finally, why the last step isn't just the most surprising, it's the reason the entire strategy works. Because once you understand buy, borrow, die, you'll realize that the world's wealthiest people often aren't playing the same financial game as everyone else. They're playing by a different set of incentives, and the difference is worth billions. The first step is surprisingly simple: buy. But not just anything. The ultra-wealthy don't spend their lives buying bigger houses, faster cars, or more expensive vacations. They buy assets. Assets that have the potential to become dramatically more valuable over time. Stocks, businesses, commercial real estate, private equity, even fine art. Because unlike a paycheck, an appreciating asset can create enormous wealth without immediately creating tax. Take Elon Musk. For most of his career, the overwhelming majority of his fortune wasn't sitting in a bank account. It existed as ownership in companies like Tesla and SpaceX. Jeff Bezos built Amazon. Warren Buffett built Berkshire Hathaway. Their wealth wasn't created by collecting massive salaries. It was created by owning assets that continued to grow. And that's a critical distinction. Imagine buying shares of a company for $1 million. 10 years later, they're worth $100 million. You've made $99 million. But under current US tax rules, that gain is generally considered unrealized until you sell. No sale, no realized capital gain. No capital gains tax due simply because the value increased. To most people, that feels strange. To investors, it's one of the most important concepts in finance. Because every year, your assets continue growing, your wealth increases, without forcing you to write a check to the IRS simply because prices went up. That's the first piece of the puzzle. But it immediately creates a new problem. Because you can't buy a house with unrealized gains. You can't fuel a private jet with stock certificates. You still need cash. Which brings us to the second step. Borrow. This is where the strategy becomes fascinating. Imagine you're worth $5 billion. Almost all of it is tied up in company shares. You want $50 million in cash. The obvious solution would be to sell stock. But selling creates taxes. So instead, you visit your private bank, not to sell your assets, but to borrow against them. Here's how it works. Your shares become collateral. The bank evaluates your portfolio. If it believes the assets are strong enough, it agrees to lend you money while you continue owning the stock. This type of financing is commonly known as a securities-backed loan or securities-backed line of credit. For the bank, it's attractive. The borrower owns billions in assets. The collateral is substantial. And if necessary, the lender has legal protections built into the agreement. For the borrower, the advantages can be enormous. Instead of selling $50 million worth of stock and potentially triggering a large capital gains tax bill, they receive a loan, and loans aren't considered taxable income. That's the key difference. You're not earning money, you're borrowing it. Meanwhile, the original assets may continue appreciating. If the portfolio keeps growing faster than the cost of borrowing, the strategy becomes incredibly powerful. It's one of the reasons financial journalists often describe billionaires as asset-rich but cash-light. Not because they lack wealth, but because selling wealth can be far more expensive than borrowing against it. And that's where most explanations stop. But they're missing the final step. Because borrowing alone doesn't complete the strategy. The third word is the one that makes buy, borrow, die one of the most debated wealth strategies in America. The final step is the one that gives the strategy its name. Die. It sounds dark, but in finance, it's simply about what happens when wealth is passed to the next generation. Under current US tax law, many inherited assets receive what's called a step-up in basis. At first glance, it sounds technical. In reality, it can have an enormous impact. Imagine someone bought shares decades ago for $1 million. Over time, those shares grow to 100 million. If the owner sells while they're alive, they may owe capital gains tax on much of that appreciation, depending on their circumstances. But suppose they never sell. Instead, the assets pass to their heirs. Under current law, the tax basis of many inherited assets is generally reset to their fair market value at the date of death. That means if the heirs decide to sell shortly afterward, they may owe little or even no capital gains tax on the appreciation that occurred during the original owner's lifetime. The appreciation isn't taxed in the same way many people expect. And that's why the third step matters. The strategy isn't simply about avoiding taxes today. It's about allowing wealth to continue compounding across generations. Buy appreciating assets. Borrow against them instead of selling. Pass them on. 3 simple ideas. 1 remarkably powerful financial framework. Of course, none of this means billionaires never pay taxes. They pay property taxes. Corporate taxes affect the companies they own. They may owe estate taxes depending on how their wealth is structured and the laws in effect. And there are many rules, risks, and exceptions. But buy, borrow, die explains why enormous fortunes can continue growing for decades without constantly triggering capital gains taxes through asset sales. Whether you think that's brilliant or unfair depends on your perspective. Supporters argue it rewards long-term investment and entrepreneurship. Critics argue it allows the wealthiest families to accumulate even greater fortunes while paying lower effective tax rates than many ordinary workers. The debate has been going on for years, and it isn't ending anytime soon. Because every proposal to change the taxation of unrealized gains or inherited assets immediately becomes one of the biggest political and economic battles in America. So the next time you see a headline saying a billionaire became $10 billion richer, remember this: net worth isn't cash. Owning isn't selling. And in the world of extreme wealth, that difference changes everything. We've decoded the system. This is Luxury Decoded. Subscribe for more hidden systems behind wealth, power, and luxury. What should we decode next? Tell us in the comments.